Welcome to my channel. Today's class is about the preparation of balance sheet of the new firm with the change in the profit sharing ratio in the case of admission of a partner. Reconstitution of the firm calls for a change in the value of assets, liabilities and capital of the existing firm. So we should prepare a balance sheet for the new firm incorporating all such changes. In such a case, we must show the revalued figures for the changed items and for others at their old values in the balance sheet. A balance sheet is given. Anand and a question related to this one. Anand and Babu are partners in a firm sharing profits and losses in the ratio of 2:1. Following is the balance sheet as on 31st December 2011. Then on 1st January 2012, they decided to share the future profits and losses in the ratio 3:2. For this purpose, assets are valued, revalued, and liabilities are reassessed. Accordingly, machinery were revalued at 20,000, stock 12,000, buildings 44,000. We are required to pass the necessary journal entries and in the books of the firm and with the effect in the changes in the profit sharing ratio. So for this purpose, first we have to pass the journal entry, then we have to write the heading as books of Anand and Babu, then we have to draw the journal. The date will be the revalue date, that is on 1st January 2012. Then the first entry will be related to transferring the general reserve to the respective partners capital account. The entry for this one is general reserve account debited. Partners are Anand and Babu. So to Anand's capital account, to Babu's capital account. The total amount of general reserve is 12,000. It is divided in the ratio, old ratio, that is 2:1. So 12,000 into 2 by 3 will be 8,000 for Anand and 12,000 into 1 by 3, 4,000 for Babu. The narration is general reserve transferred to partners capital account in the profit sharing ratio. Then we have to show the revaluation amount, journal entry related to the revaluation amount. Here, machinery, the amount it is revalued at 20,000. The original value for this one was 25,000. So there's decrease in the value of machinery. Stock, it is 12,000 and the original value is 15,000. It is also reduced. Then the another one, the buildings revalued at 44,000. Original value is 30,000. So it is increased. So we have to first show the decreased value of assets. For passing the decreased value of assets into revaluation account, the entry for this one is revaluation account debited to the decreased assets are machinery and stock. So to machinery account to stock account, the amount of decrease to be shown, that is machinery 25,000 was the original value minus revalued value 20,000, that will be 5,000. Stock original value 15,000 minus revalued value 12,000, it will be 3,000. Narration, decrease in the value of machinery and stock transferred to revaluation account. Then the increase in the value of building. The entry is building account debited to revaluation account. Original value 44,000, revalued value 44,000 minus original value 25,000, 14,000. Then the narration is increase in the value of building transferred to revaluation account. Then we have to keep a blank space for writing the journal entry for the profits or loss for revaluation account. Then we have to prepare the revaluation account. Here, as we have said earlier, two items will be shown in the debit side and other items will be shown in the credit side. Revaluation account is a nominal account. So machinery and stock should be debited and building account should be credited. Then the total amount, the credit balance is more, 14,000 minus debit side will give the amount 6,000. This 6,000 will be divided between the partners in their old profit sharing ratio, that is 2:1. So 6,000 into 2 by 3 will give 4,000 and 6,000 into 1 by 3 gives 2,000. Then we have to prepare the capital account. Capital account, there will be 2 columns for the Anand and Babu in the debit side and 2 columns in the credit side. Capital account carries an opening balance, credit balance. So balance brought down. The opening balance for the one is given in the balance sheet, that is 40,000 and 30,000. We have to show that one. Then the reserve, general reserve amount, the amount transferred to the capital account of the partners, general reserve 8,000 and 4,000. 8,000 and 4,000. Then the revaluation profit that we have already computed, the 4,000 and 2,000. Then there is no other items to be shown on the debit side. So credit side minus debit side will be the closing balance. That is balance carried down. That will be 52,000 and 36,000 respectively. Then we have to prepare the revalued. After revaluation we have to prepare the balance sheet. So balance sheet as at 1st January 2012. Then the cash at bank and cash in hand shown at the original figures, that is 9,500 and 500. Then the building, machinery and stock will be shown at the revalued amount. That is for machinery 20,000, stock 12,000, buildings 44,000. Then the debtors amount, should be shown in the original amount. There is no revaluation amount in the value of debtors. That is 10,000. Then on the liability side, there will be creditors 8,000. General reserve note should be shown. That is already transferred to the capital account. So it's not taken in the balance sheet. Then the capital account, amount transferred to capital account. That is the closing balance of the capital account, 52,000 and 36,000. The closing amount will be the 96,000. That's all for today. Thank you.